Our first question that came in. Kenneth says, I know you don't give investment advice, but just thought I'd mention that Tesla looks quite attractive for selling cash secured puts. I sold two January 6th, 118 puts today for $2,000 worth of premium. All right, fantastic. That sounds great, Kenneth, and we hope it works out. But let's go ahead and just take a look at what we have for Tesla. Now, what I'm going to do here is go through the process of what I always do on a coaching session, or what I always do if a PowerOptions trial member or subscriber schedules a coaching session and they put in a note saying, hey, I'm interested in stock XYZ. What would you consider about strategy X, strategy Y, or strategy Z? Before I even go into looking at the profit and loss chart of a given position, yes, Kenneth, we know what the profit and loss of a cash secured put is. Wouldn't be much of a director of education if I didn't. But I always want to just take a look at the quotes page and the stock chart first. I see the news articles, but I haven't been following Tesla. But I see the news articles that come out every day. You know, everyone gets clickbait if you write a financial investment article on Tesla or on Apple or on Amazon, Starbucks even, any of the Reddit stocks and the meme stocks. But let's just take a look here. All right. So what am I really looking at? I've got all this gaggle of numbers here. I've got volume. I've got average volume, 90 days worth of 90 days average volume. Number of days to short interest. Last price 123, range today, so on and so forth. I've got volatility numbers out the wazoo, 20, 50, 100 day, 250 volatility in the simple moving average, well below the 20-day and the 50-day moving average. That's fine. You might have think that it bottomed out. What I'm really doing when I come here, of course, is my eyes are going right to this. Okay, I wanted to see if there was any earnings coming out between now and the expiration date that was selected by the gentleman that asked the question, or person who asked the question about the coaching session. I need to know what's going on in the background first before even looking at the structure of the trade. All right, so we know that it's unconfirmed, but the expectation is the earnings are going to be around January 25th. That's not going to hinder us at this moment for this trade. Then, of course, I want to take a look at big charts or stock charts. I use big charts. I have it customized for my view. See what Kenneth is thinking here. Of course, as I mentioned, we see that decline just in the last few months here on Tesla. Hitting a bottom, well, I don't want to say hitting a bottom, because every time it looks like we've hit a bottom, it kept going. But we've seen a little bit of a rally here. I'm not going to say it's similar to what we saw before, but we're going to take a look at that. Yeah, it's not similar. Oh, it is kind of. What I'm looking at here, and I think some of you might have already been able to see it, is yes, I prefer to use the Bollinger Bands as my settings. It's very similar to how Ernie sets up his chart as well. Selecting the SMA 20, the Bollinger Bands, the MACD, and the RSI. Now, I don't use the RSI as an indicator for getting into a trade. I usually just use the RSI as a tertiary indicator for an exit on a position. But we can see what Kenneth is thinking. We've had this slope downwards, and it seems to have wanted to bottom out here on both the Bollinger Band and the MACD, and we've seen some movement upwards, and perhaps thinking about a positive crossover in this case, where the MACD might cross the signal line, might be a good signal of a stabilizing or more bullish trend. And of course, we only have 6 days to go. Well, 7 days to go, technically, calendar days, that is. Now, what I was thinking about is when I said that, you know, we've hit the bottom, or maybe we've hit the bottom, this pattern, and it's not really a pattern so much, it's not duplicated in this time frame, but there is something interesting here I saw right away. Riding the lower Bollinger Bands, and then we have a slight uptick with what looks like a bottoming out of the MACD. And a couple months ago, about a month ago, it looked very similar. In other words, we have this riding of the lower Bollinger Band, a little bit of an up, and then riding the lower Bollinger Band, and then a little bit of up. Now, if it stays this way, Kenneth's position will be fine. But if it triggers faster for some reason, and this starts to move back down, well, that might be a problem. Again, he's at the 118 strike, and the stock's at 121. I think is what we saw in the close today. Is it 121.37, 123.18? I'm sorry. I must have reversed those numbers in my head there. So 123.18 is about 5 points out of the money with 6 days to go. I wouldn't say that it's showing necessarily a bullish trend. It seems to be showing a bottoming trend, but again, we saw that too here, where it looked like it is bottoming and it was going to have a positive cross, and it did, but then we started to just drift back downwards. And again, that happened over an 8, 9, 10-day period, so maybe that's okay. This one was very similar as well, although it was much more rapid back up than we saw here, and then we're seeing here. This is just a little bit push upwards. All right, so that's the technical side. That doesn't mean really much of anything. It's just what I would look for in the position, and when a question comes in, that's where I always start off with looking to analyze the customer's view. Are there earnings or a dividend coming up, which really only relates to a covered call position? What is the trend that we're looking at? What are the risks that I see? Well, I just sort of outlined that. In those cases, what are the positives I see? Well, the last time we saw sort of an uptick, it did last for about 7 to 8 days, same as over here. So maybe that's a good signal for this position. Now that we have that in our back pocket, what I would do if I was analyzing a new trade myself or looking at the backgrounds to help a customer such as Kenneth during a webinar or during a coaching session as well. Now we can go to our custom spread tool, and so just put in TSLA. I don't know what day you did this, Kenneth, of course, but for next week, January 6th, the 118 strike puts, 410, so you probably did about 5 contracts, I guess. I'm going to assume that you got about $4 for it, so we're going to assume 5 contracts of the Tesla position. It's going to be a little bit more than the 2,000 you mentioned, but hey, we're going to be right about there. 2,112 with a margin requirement or cash secured requirement of about, 59,000 to cover 5 contracts at the 118 strike. Now, either way, Kenneth, we're looking at a good break even at 113.78. So it's a 10-point drop, which would, be roughly about an 8% decline on a 123 stock there in that case. So Tesla could fall 8% in the next 6 days before you really start losing money on the position. Of course, we know that if the stock falls below 118, you may face the obligation to buy shares of stock early, depending on the drop, depending on the decline as well. Position comes with risk naturally. The risk, of course, is to the downside, just like a standard covered call position or any naked put or cash secured put. I'm not saying Tesla is going to drop to 99. I'm not saying Tesla is going to drop to 105, but we've been in choppy markets. We don't know what 2023 is bringing us yet. Hopefully next week there is sort of just a sigh of relief, a relaxation in the 4 days of trading for the shortened week next week before people start to digest, investors start to digest new economic data, new things that are coming out, and we could just get a break of a nice, calm, neutral market, especially for Kenneth's position. And maybe we'll see a strong uptick. I doubt it, but maybe we'll see a good uptick as we've seen the past few days. Not really a Santa rally at all. That completely petered out. So it's got good premium. We saw that in the volatility, of course. Back on the stock details, the volatility of the 50 days around 0.70, 20 days 0.75. The SIV is the stock's implied volatility index, is the average implied volatility of the in the money and out of the money near-term options is at 0.83. So it's a pretty strong implied volatility, pretty decent return. No questioning that. Reasonable range out of the money. Maybe I'd like to go a little bit more for a little bit more protection, Kenneth, personally, especially the way the markets have been in the last year, the last month, the last 2 weeks, for example. But you've got about an 8% drawdown to 113 from the current stock price. Good return of 3.7% with a slightly out of the money put option. It's a strong position graphically. It's a good return with the implied volatility. The risks, of course, as we've seen, are what has been happening with this position. Do we trust the bottoming and all the easing as Elon Musk took money out and money out and money out and bullish Tesla investors got fear as they saw the value of the stock decline and decline and decline. You know, Tesla's not going to disappear. It's still going to be around for the next 6 days. That's not a worry. But again, every strategy comes with its risk. We see the risk up front here. Now, the important question, what to do if X or Y? Well, on Tuesday, if the market opens, a Tesla goes up to 127 or 128, you're looking pretty good on the position. You'll have an extra 3 days of time value decay. Let's see what our expectation would be. The stock jumps up, and it's not even a big jump, but let's just say the stock moves up to 127 on the 3rd. There we go. So we see some decline here and some profit expected, even with the volatility. Why are we expecting so much profit to be had on the position? Actually, let me just change this real quick. I apologize. Let's just change this to one contract so it's easier there to discuss. Naturally, Kenneth probably got around $4 for this, or if he got $5 per contract, he did 4 contracts. Let's just put it at 1 and do that number again, 127. Not a big move for Tesla even. And when the market opens on Tuesday, so we would expect the premium to drop to 124 based on the Black-Scholes pricing model. So profit of a little bit more than 50% of the max you expected to make on the position. Get that extra day of time value decay, only 3 days left now to expiration. So you're looking pretty good, even with that high implied volatility. Reverse end, of course, we drop down to 119. And we still expect to see basic profit, even with the higher volatility, because you're going to have 50% of the time decay on the near term. We get the Saturday and Sunday decay and the extra Monday decay as well. And of course, if the stock hits your break even, was a little bit above 113, yeah, 113.78. So let's just say it goes 113.75, opens on Tuesday, down 10 points. Not saying that's going to happen, but this is our what if scenarios. This is how we evaluate the risks and what we might want to do to avoid situations. Well, we'd expect the position to go up, buyback cost at 655, looking at a loss of 232 on the position, which would be about 1.5% of a loss against the full cash secured position, Kenneth. So in this case, what would I be doing if it was at 113? Well, I'd naturally be looking to roll down the position, manage the cash secured put with a sudden break. Now, I might have to change my trading plan. And what I mean by that is, Kenneth, you open this position with 6-7 days to go to expiration. Now that if it does this scenario and falls down to 113, suddenly gaps down 10 points or so, opens at 113.75 on Tuesday morning, you're probably not going to be able to, actually you probably could, but you might be able to roll it out to the next week, to the 13th of January to get a new premium. But now the stock's showing you a negative bias. It's against what you were doing. You'll probably want to go out 3 weeks out in time and go further out of the money, or maybe change the structure depending on the news and why the fall of 10 points over the next 3 days and the sudden gap down on Tuesday morning, for example. Maybe close out the naked put for hopefully only that small loss, not too much more. Then, if you still wanted to trade Tesla, but your sentiment's changed, convert to a bear call credit spread, or just do a bear put debit spread for the next week or 2 weeks out in time to help cover the loss of 232 you took on this position to try to get back to break even. Trigger points. A question comes in and says, when would you manage it? As a general rule of thumb for a cash secured naked put, I usually tend to use sort of the same trigger points I'd use for a bull put credit spread, where if I'd sold the 118 put and maybe bought the 115, I'd have a profit and loss chart with a little bit shallower profit than Kenneth has, but I'd have a known risk in place if the stock fell below 115. I'd still be losing 100% in that case of the difference in strike prices or margin requirement of the bull put credit spread. But again, I might be looking at a 12-15% leverage return due to the lower requirement of the difference in the strike prices. Regardless, the 1% rule. I look to start considering adjusting, rolling, or managing cash secured put or a bull put credit spread if the stock reaches within 1% of the short put strike price. So we sold the 118, and naturally 1% of that would be $1.18. So if the stock fell to about 119.20 or 119.15, that's when I'm seriously going to start considering, do I need to roll this down? What is my buyback cost? Am I at a small gain or small loss? Should I just close it for the small gain? Should I close it for the small loss? Should I roll this down to a lower strike price in a week or 2 weeks out in time? Because I think the decline that just happened was an aberration. I'm still bullish on the underlying security longer term. Or exit the position because my sentiments changed based on news that came out over the weekend. So the 1% rule, that's when I usually look to manage. Now, 5 minutes ago, I'm sorry, it's more than that, it's about 10 minutes ago, I had mentioned the chart settings that I used, looking at the Bollinger Bands, the MACD, and the RSI. Now, normally when I open a cash secured put, and this doesn't mean I'm a better trader than Kenneth by any stretch of the imagination, but I usually tend to follow a trend rather than follow a stock and look for bottoming points or things of that nature. You could be very successful doing that, don't get me wrong, as long as it is a true bottom and the stock at least holds or moves back up, as again, we've seen 8 days there and 8 days there. Let me just pull up, I think Schwab is a good one real quick. I'm using this because this is a recent married put that I had opened. And I opened it on the 27th when we saw a positive MACD crossover, RSI was moving up, and the stock was above the 20-day moving average and in a strong uptrend. Now, naturally, yes, I would have liked to have gotten in the position here at what might have been a bottom similar on the MACD to what we're seeing with Tesla. But again, I'm not sure if that's a strong enough one yet. It's down below the divergence line. We're not going to get too much deeper into MACD. I know that might be confusing to some of you without going into each one. So the MACD essentially is based on the 12 and 26 compared to the 9-day exponential moving average. It does look like an alien smiley face there, but okay. But here's where I'm going with this. Let's say that I had sold the 79 strike. So my 1% rule would have me at about 79.79. Maybe we just call it 80, but we'll call it 79.75 would be my trigger point to potentially manage or adjust the position. Now, what else can I see from the chart here that would happen if Schwab fell to my 1% rule? Well, the stock would be likely trading now below its 20-day moving average. I opened the position when the stock was above the SMA 20 as one of my filters. If it hits that 1% rule, I'm now going to be below that SMA 20. Also, I likely would have seen the opposite here. Allow me to do this. We're going to find, I'm sorry, just going to change colors real quick. What I would have started seeing here is that this would have started to dip, where the signal line would have started to move up as a negative MACD crossover. It wouldn't be that exaggerated. It might be if it suddenly opened at 79.75 on Tuesday. And the RSI would have started to show weakness instead of strength. If I'm at or near my 1% rule, whether in a naked put, cash secured put, bull put credit spread, and the stock has now reversed the trend that I wanted for the trade, is now trading below the SMA 20, and I'm seeing a negative MACD, and the RSI is pulling negative, the tertiary indicator. If I have all three of those in the 1% rule, I am just closing the position. I'm just getting out of it. And if the loss is a little bit big, the loss is a little bit big. Why? Because I was wrong on the position. I'm not going to just roll down and say, oh, it fell below 79.75. There's no way it's going to continue down below 75. Oh, it's dropped to 75.10. There's no way it's going to drop below 70. Oh, I've rolled 2 months out in time for a credit, or 3 months out time for a credit, and the stock kept falling, and now it's below my new strike price at 70. That's the thinking that got a lot of investors into trouble in 2022, and why we had several webinars earlier on in 2022 from January to February about managing now deep out of the money covered calls, and deep in the money cash secured puts. So you can think the stock won't breach that next point. But hey, I mean, you can look at it here. Just a couple of months ago, Schwab was trading down at $66 per share. It's a possibility in the worst case scenario and further negative economic impacts that it could drop down to those levels again. That's why I'm trading it as a married put position with only a risk of 7% as opposed to a covered call or cash secured naked put or a bull put credit spread even. I like the trends. I like the chart. I liked everything I saw, but I opened this as more of a longer term married put position 6 to 7 months out in time. But I just wanted to illustrate that as to why I'm using these three selections. And I shouldn't say that they're my selections at all. This is really based on what Ernie showed me over the years of how he uses it and what he looks for. So I've sort of mirrored him because he's usually more right than I am about stock direction. And I'm trying to learn the best from my master so that I can give that information to you. But that's what I look for as far as a management. So the question that came in, the comment that came in from James, I believe it was, is when would you look to manage it? The 1% rule, stock reaches within 1% of my short put strike price or the sold put strike price. And if the technical indicators that I use to get into the position, if 2 or 3 of those are now being violated, in other words, the stock is now going in a downward trend, and I'm seeing a negative MACD crossover, if I use those as technical filters, if you use stochastics, that's great too. But if the stochastics change from bullish to bearish while you're in a naked put and you're at the 1% rule, you may want to consider that being the time to manage, to close, or just get out of the position for a small loss, rather than allow it to keep going and saying, oh, I can just keep rolling for a credit and rolling for a credit and rolling for a credit. And now you're 3.5, 4 months out in time, waiting and waiting for time value decay or hopefully the stock to stabilize. And again, that's where we saw a lot of investors get into trouble in 2022. So, wrapping that all up, what did we just take a look at? Well, we talked about analyzing some of the basic raw details, looking at what's coming up. You would have already done that before you entered the position as far as earnings, but just the process of what I look through when every question like this comes in, I take a look at what I need to see in the information here. Got to take a look at the stock chart to try to analyze what was the thought process here, what was the sentiment going in, and I can see Kenneth's sentiment is believing that there's a bottom here, high premium as he mentioned, good break even down to about 7.5%, 8% from where the stock price is now to the break even around 113.70, 113.75. Good premium again. I like to mention that, and the potential for a good strong return for a 6-7 day trade if the market behaves, if the market gives us just that sigh of relief going into the first 4 days of 2023, where we don't see a lot of hiccups, don't see a big drop over the next 3 days. So Kenneth, that's my thought process here. Also the thought process of when I may look to consider managing the position depending on what happens going forward, how the market opens Tuesday naturally. I know I don't need to say that, but it's, you got to react to what happens with the weekly options in this case. You don't have a lot of time to just step back and say, okay, I'll see how this pans out on Wednesday or on Thursday. By then, you might be at a much bigger loss. So when you're doing the weeklies, you usually have to react more quickly with those sudden market shifts. And we've seen a lot of those sudden market shifts, of course, in 2022. And we're hoping for more of maybe a tame market in 2023. But with all the talk out there, fears of recession, and there's a lot of talk coming out this week about ways that the economy could easily recover in 2023. Just remember the key points for any strategy: proper position sizing, make sure you're not risking more monetarily than you're willing to take, and using shorter term weekly positions or even the daily options now with some of those SPY, SPX securities and so forth. Got to be a little bit more nimble so you don't allow any losses to get too far away from you in those cases. So Kenneth, I hope that helps you out a little bit. I hope that gives you some insight. I hope that gives some other investors insight into these positions and my thought process too. It's always important for me to share my thought process going forward. and how I evaluate your questions